Good evening, everyone. Welcome to Investor Education Week, day 4. And today we'll talk about technical analysis. I already see a lot of questions coming in for the technicals. And okay, and there are a lot of questions coming in. So, first of all, most welcome to everyone. I see, as usual, the names which I have seen from day one. I hope all of you are practicing at home using your demo accounts. And side by side, when we learn something new every day, I hope you're trying this in your demo accounts also. Those who have joined today, I see a lot of fresh names today. So those who have joined today, don't worry about it. You whatever you have missed, you can always go back to YouTube Century Financial channel and subscribe. And we are soon going to upload the copy of the last few days what we have done here. And to everyone else, if you need any kind of one-on-one session regarding and to understand more, because obviously we have a lot of time constraint over here. So sometimes I'm not able to answer all the questions, or sometimes I may need to explain something a bit more, but I'm not able to due to the time constraints. So you need any more explanation, we can have definitely have a one-on-one session. Just talk to your relationship managers and they can fix it. So, guys, yesterday we discussed about fundamental analysis. Before we proceed, would like to see if you can answer this question, which is the most important jobs data? If we are talking about the jobs report, we talked about the labor data yesterday. Which of these data do you think is the most important job data? Go ahead, guys. I see everybody voting. Just try to remember what we discussed yesterday. Which is the most important job data or most important job report? Go ahead, guys, vote. I'll give you 2 minutes to vote. Okay, both are important, but unemployment more in terms of job. All right. Okay, let me. Okay, I'm going to end this poll now and begin my session. And let me show you what you have voted. 71% said NFP and 28% said unemployment rate. So just so you know, see, both data are important. Most important data is NFP. And when I say most important, because there is a lot of market movement which happens for the non-farm payroll. And I'll tell you the reason also. See, the unemployment rate does not changes much, but when it changes, it is significant, but normally it remains constant. However, non-farm payroll month on month shows a lot of fluctuations because this is the monthly data that how many people in US got employed in the private sector. So NFP data or the non-farm payroll from a market point of view is really, really important. So you should definitely be checking this data out if you're a day trader. And if you need to build a strategy on that day, you need to be very careful and you have to understand. So good. I think majority of you are on the right side. Those who said unemployment rate, you're not wrong. Unemployment rate is also really important because if the unemployment rate of any country increases, it's a difficult thing. But non-farm payroll, in terms of economic data, will be more volatile and more crucial for you as a trader, right? So just keep that in mind. Uh, Before we proceed, please, as usual, I have my notepad with me. Would really request you to have a notepad with you So today, whatever we discuss, you can note it down, or if you have any questions, you can note it down, and we'll be able to answer these questions. Um, we are also going to use our platform today a lot because we are talking about technical analysis. So if you have your demo accounts, you can log in and practice while I'm doing it, or just have a look at what I'm doing, and you can practice later on, whichever way you find it convenient. Before I start, as usual, please, for those people who have joined today, investments or trading, speculation, these have a substantial market risk. Whatever I'm telling you today, it should not be taken as a recommendation or a suggestion. This is for information purposes. Until you discuss this with your financial consultant or with experts, or maintain your risk appetite, understand your risk appetite, and until you do that, please do not take any of the trades or strategies what you see here. It's for your information purpose. Look at it and understand how markets work. That will definitely help you to decide your future course of strategy. But this everything which I'm doing is done in a demo account. If you any of you have a live account, please do not take trades on the basis of what I'm doing currently. That's just for information purpose. Okay. If you have demo accounts, no problem. You can take trades in your demo accounts because that's dummy equity, but not in your live accounts. Second thing, please do not borrow money, or please do not take loan for trading, speculation. This is not one of those sessions where I tell you how to get a Ferrari or a big house. There is no tricks to trade. There is no secret strategy to make money. This is not one of those webinars, and it is never going to be. So please understand the market risk, uh, work hard, and try to understand how we have grown day over day from asset classes to understanding how to buy and sell, to risk management, diversification, sectoral allocation, and yesterday to fundamental analysis. And today we are going to read about technical analysis and charts. Needless to say, please do keep writing your questions. I see a lot of questions coming in. Please don't worry. Once I finish this session, I'll be able to answer those questions also. Now, today, friends, will start with technical analysis. Yesterday, I talked about fundamental. I gave you an example, a news about pandemic, a news about trade war, news about Brexit, anything and everything which is a market event, which is an information, whether earnings of a stock or US elections, all these news, a vaccine coming into the picture, all these kinds of news, it affects the stock prices. It affects the prices of commodities. It affects the prices of currencies, central bank decisions, manufacturing data, oil inventories, all of this, right? So that when you look at the news and take a trade, that's called fundamental analysis. But then there's another branch of analysis, and that is called technical analysis, which is completely depends on the charts and the graphs, the historical price movement. Sorry. Yeah. Now, technical analysis, forecasting of future financial price movements based on examination of past price. So what you see is you look at the past historical prices, and then you try to forecast what the future trend will be like. Now, that may or may not happen. So that's why technical analysis comes with a set of assumptions. First assumption, history tends to repeat itself. So that's the first assumption, which says that history is expected to repeat itself. So if you have seen historically that, say, Airbnb stock falls down to 123 and bounces back most of the times, then next time when it comes to 123, you would expect to go for a buy because you have seen in the past that it has touched 123 and bounced back, because you are assuming that history tends to repeat itself. That's the first assumption of technical analysis when you are doing analysis on charts. Second thing, the price always moves in trends. This is again an assumption where we see either the price moves in an uptrend, moves in a sideways trend, or it comes down and it moves in a downward trend, but it will always move in trends. So that's how you can do a trend analysis and take a trade. Third, market discounts everything. Now, why this assumption is really important, because when you are doing a technical analysis, when you're reading charts, tsunamis and pandemics should not affect, because that's what this analysis says. It says that market has discounted already everything. So the price, probably what you see, is under a very efficient market and it has discounted everything, all the news events. So the current price, whatever you see right now, is, it has discounted all kinds of market news, and that's the pure price which is there. So when you assume this, that market has discounted everything, so now the price which you see is excluding every other market event, or it includes every market event, and now this is the final price. Then you try to do your technical analysis, right? Because if so, we'll proceed with this and we'll try to understand that what this analysis further means. Now, we have seen in last few days a couple of times, not too much, but I opened sometimes the chart to show you the trend, right? And in that chart you saw red candlesticks, you saw green candlesticks, but what a candlestick actually is. So we are going to learn today the very basic and introduction of technical analysis. The part two of this will be taken care of later on, and not this week, but in the next few weeks. I will bring Vivian, who is one of our major technical analysts. And once you understand the very basic and introduction of how charts work, we will talk more about studies. We'll talk about how to draw harmonic patterns, Fibonacci's, and other areas. So that is something, again, which is advanced technical analysis. And one thing also which you should remember, not knowing charts or technicals is not the end of the world. You don't have to pay to any financial institution, or you don't have to pay any educational institution to learn these things. You go on Google and talk about candlesticks, you will find a lot of data. So there is no difference whether you learn it here or pay money and learn somewhere else. It's going to be the same result. So why I'm telling you this, because most of the people think that technical analysis is the key to everything. By the same token, some people think fundamental analysis is the key to everything, right? Today, if I am looking at a stock, it suggests a good buy, but there's a pandemic going on. So you will question that why would you buy this stock just because you see it technically? There is a pandemic going on, so it's definitely should not be a buy. You should short sell it, right? So there can be always a difference of opinion. That's why you try to understand that how you can determine the trend and how you can exploit support and resistance levels. And when I say support and resistance levels, it means a kind of range where you should sell and where you should buy, where you can take entry and exit. So today I'm going to tell you that. Before this, let's understand the anatomy of a candlestick. Now, the traditional candlestick was black and white. Black means the closing has been negative, and white means the closing has been positive. But in modern charts, normally what you will find is green and red. Green means the closing has been on the higher side, while the red signifies that the closing has been on the lower side. So if you see the first why we call it a candlestick, guys? Because if you see a candle exactly looks like what you see here in the presentation. It has a thread where you light it up. So every candlestick also has a thread, but this candlestick, the thread which you see right there, here, this, let's take the green candle first. So this thread which you see right now, I'm going to make it in my notebook to show you. Look at this thread. This signifies the highest point the price reached. So what the candlestick denotes, it denotes the price movement. Okay, it denotes the price movement of a specific period. If you're looking at a 2-minute candle, then in entire 2 minutes, how high it went and how low it went. So if you see the lowest point, how can you find the lowest point? By looking at the lowest thread of this candlestick. This entire candlestick stands for 2 minutes. In 2 minutes, the price went to the highest of this and the lowest of this. And if it ends green, that means it closed at a higher price than it opened. A lot will be clear when I open the charts and show you how it works, right? So I'm going to move on to my demo account, which I've been using since day one. Those who have your demo accounts, you can log in now and let's try to make the best use out of it. So I'm going to trade room right now. Okay, this is my demo account. I've already, so just to show you how do we log into the demo account, let me close all these. I'm going to log out first and show you. So you go to the link which you have bookmarked, put your demo ID, and then put your password, which will be century12345 for all the demo accounts. Press enter, and then you will be logged into the real-time platform where the prices you see are real-time prices. Okay, before we move on, what was the price yesterday? What was the price of gold yesterday? And what price I bought it? First, tell me at what price I bought the gold. I asked this question yesterday also. A lot of you answered, just making sure that you are tracking this every day. What was the price at which I bought gold? I said it out loud yesterday. Okay, not at 1840, not at 1850. I've got one right answer. Others, just give it a shot, give it a try. See, this is not in your regular routine, so don't worry about it. Just try. Don't worry about it. 527, no, 527 could be the price of something else. 1228, I think somebody wants to say 1828. No, not 1228, 1228. It's been a while. Others, try. What price I bought gold yesterday? So, friends, what I'm trying to do right now with you, I'm trying to form an anchor in your mind. Now, in the last 3 days, I've asked you twice at what price I have bought gold. So now most of you said 1828, some of you said 1820, 1840, 50. At least you know what's the price of gold right now it is. So tomorrow again when I ask you what price I bought gold, you will be able to see the price difference. Now let me show you. I bought gold yesterday at 1820, day before yesterday at 1828. I did not close my trade. It is still going on. So as you can see, right now, again, it's a highly leveraged trade. So I have $1 million worth gold bought at 1828. So making $15,000 profit because gold has gone up to 1856. But that's not the just the highest today. If you see the highest today, right now, let me open a quote panel for you. Look at this and tell me what is the highest. Look at both of these prices. Tell me where can you find the highest price? Anyone? I hope you can see this. What do you think is the highest today? Look at this quote panel. The answer is right there. Current price is 1857, 1856, 57. It is changing. Okay, I got one answer. Others try. What is the highest? What's the highest price? The answer is in that quote panel. Just you have to look very closely and you will find it. Brilliant, brilliant. Everybody can see this. Absolutely amazing. So 1866, you can see right there below the buying price, it says H 1866. Lowest is 1849, which you see on the left side, which means today 1856 is the current market price, 1866 is the highest, 1849 is the lowest, which means gold already today has given a movement of $17 to $18, right? And US has just opened an hour ago. The US stock markets have opened an hour ago, and we have seen that gold is already moving at least $17 to $18. So today we are also going to discuss about the average true range of every product. So that will help us out. Now, first things first, let's try to understand how candlesticks work. Also, Guys, I told you the crude oil inventory comes every Wednesday. It is 7:26. So go to your news and analysis section, open your market calendar, and you can see the highlighted. There are two important news today. One is 11 p.m., the FOMC decision, the Fed policy rate. And the second news today, what we are talking about, is the crude oil petroleum report. Also, what you can do is search crude oil in your product library and search West Texas. West Texas is a US oil. So crude oil West Texas January 2021. You can see it right here in your product library. You just have to search crude oil and it will come crude oil Brent and West Texas. So click on West Texas, the first contract you see. And now I'm looking at this chart. So whatever chart you open right now, look at here, look at the left side and select this duration or the interval right here. You can see my chart. Make it 5 minutes. So you can see that how after the news every 5 minutes, how the price fluctuates. Those who do not have demo accounts, write down on a notebook. The price of crude oil right now is $47.48. Okay, $47.48. Now, oil inventory last time was 15 million barrels. Now, this time they're expecting a decline, 2.6 million. If there's a decline, the prices should start going up for a very shorter time frame. But if it is again in too much excess, then the price should drop looking at the time frame. 2 minutes left before this news comes. Search, guys. Gold moves 24 hours, almost 24 hours, 21 or 22 hours, you can say. There's a 1 hour gap, but otherwise Monday to Friday, 24 hours. For now, please open news and analysis, market calendar, so you can see oil inventory data live. It is already 7:28. It is going to be coming in the next 2 minutes. You can also put alert in your news right here. This is the petroleum data. So when you click on this, single alert, and now you have the alert coming in. So when I open this data will come out right here. So I've already opened alert. As you can see, the countdown is going on 30 seconds before the news comes in. And also meanwhile, we'll see the impact. I've opened a 5-minute chart duration. So see how already from 47.58, it has started coming 47.51. Okay. So I want to see the news at the same time. Look what happens. I'm zooming this in for you. Look what happens when the news comes in. If there is a significant difference, then the chart can move a lot. If there is no significant difference, then we won't see much movement right now. Okay. And it's due now. Look at this. Did you see this bar? 47.72 right now. The news just came. The inventory is negative. So that is expected data which can push up the prices. Now look at this. This is a 5 minutes candle you're looking at. So in not even few seconds, look at this, how it's going, 47.78, right? The prices just went up. So it is moving. The moment it makes a high, the thread becomes, and then it just touches and starts coming down. So as I said, for day traders, this is something which you can really look into, the economic data. If you saw this, please give me a yes or a okay. So I would just know that how many of you were able to see the movement on this data. I intentionally have put a 5 minutes candle to show you that on the time when the data comes in, how the prices move, and specifically when it's a oil inventory data. So you see the data came negative. For the 5 minutes, we saw a big candlestick going on. Question, why in a drop the candlestick is green? Because the closing yet is not negative. This candle closes in 5 minutes. If the closing price of this candle in these 5 minutes is lower than the previous 5 minutes, then it will become red. Right now, if you see, the candle is in green because the previous closing is lower than this, the previous 5 minutes. Now, right now, it's just been right now, I think this is a candle which will continue. This is started at 7:30. So for the next 4 minutes, this candle will be fluctuating at different price level. If you see, the highest it went was 47.79. So from the price of 47.47, it went to 47.79. So it's almost, when we talk about 30 cents movement, 30 cents movement means if you had 1,000 barrels of oil, 1,000 barrels of oil will be equal to $50,000. If you had 1,000 barrels of oil, you'll be making $300 profit. If it goes down by 30 cents, you'll be making $300 loss. So it depends, guys. Again, if you're a day trader, if you're a speculator, and these kind of news over the long run, also if the difference, so right now the difference is significant. So we saw a significant movement. Obviously, when the difference is huge, we might see this going on a different line altogether. Sometimes what happens, prices move up, people start booking profits, and then it comes down. So many people ask me that why, after the news was in favor of oil, oil prices fell. So sometimes the news works out. Sometimes there is a heavier sentiment which is going on. But then today is one of those days where we saw a significant increase the moment this news came and the oil went up, right? So I'm showing you the candlestick. At the same time, I'm discussing about the fundamental oil news also, because we talked about this yesterday. So I just wanted to give you a live experience. Please keep writing this prices. Right now it is 47.66. Don't forget where it started from. It started from 47.48. Now in the next 1 hour, we'll keep monitoring the price of oil, and we'll see how it moves on throughout the next 1 hour, and we'll see how much this news has impacted oil prices, right? Now, coming back to the point, when we talk about the candlestick, a candlestick, okay, now let me see it right here. I'm going to increase the size of this chart so I can properly focus. So now I'm increasing the duration of the interval of this. Now, what you see, this is a 5 minute price movement, right? So I'm going to make it a 1 hour price movement, so it is at least a bit stable, because this will now this is showing a profit, this is showing a movement of price movement of 1 hour. Okay, now I wanted to tell you how a candlestick works. Now if you see this in my chart, on the left corner top, there are few numbers which I mentioned. It says OHLC. O means the opening, H stands for high, L stands for low, and C stands for closing. Okay. I will move. So this is a 1 hour candle. The price movement happens in different time frames. So on these charts, you can see multiple time frames. If you select the interval, you can even see how every second oil price moves. So I've just selected 1 second. So I've selected 1 second. So now you see every second a new candle is forming, because this price movement is for every 1 second. If I select this further, now I've selected 5 seconds. Now this candle will remain for 5 seconds, and then a new candle will form in the next 5 seconds. See, 5, 4, 3, 2, 1, changes. 5, 4, 3, 2, 1, changes. So every 5 seconds you will see a different. Similarly, I can do this for 1 hour. So every 1 hour a new candle comes in. I can also do this for 4 hours. So now this price movement which you see, this is every 4 hours, guys. So from 4 to 7, this candle started at 7 p.m. right here. A candle before that started at 12 o'clock and it finished at 4. So this has started now. This was between 4 to 7, right? This was 12 to 4. This was 8 o'clock to 12 o'clock. Every 4 hours, how the price movement happens. So the significance of a candle is you can see a dedicated price movement for a dedicated time period. So if I click on this candle right now, it shows me the opening of this candle, the highest price during these 4 hours, the oil prices went, the lowest oil prices went during these 4 hours, and by the end of the 4 hours, what was the closing price by the end of the 4 hours before it moved on to a new candle. Then this candle will represent the next 4 hours, the highest, the lowest, what was the opening price and what was the closing price. Then next another 4 hours. So this way you can find out at shorter intervals that how every 4 hours the oil prices have moved for you to understand and make your trading plan accordingly. Okay, one question. Didn't the news say that the oil price was expected to go down? So why did it go up? So it did not say the oil prices will go down. The oil inventories data shows that how much stockpiles are there in the US inventory. So it was expected that the oil inventory will decline. That was the expectation. And it did decline. It was expected to be minus 2 million, less by minus 2 million, and it was down by minus 3. So that means less supply, still more demand. So the short term price movement went up. That was the reason that why oil prices went up as per the news. The lower the inventories, better for the price, because the inventories are low, so demand is higher, supply is less, right? So the price gets the support. But please make no mistake, this is a very short term data, short term news. This is not going to have a large impact for tomorrow or day after. So this is basically for day traders. When you're looking at the oil inventory news, it does serve the purpose. Like I showed you yesterday, like last week there was a very major difference. There was excess of 15 million barrels. So that pull oil prices down almost by $1. Right now, what we have seen is a movement of 30 cents, 31 cents, right? So that is something which you have to note. Coming back to the candlestick, just look at this data. So right now, I hope everybody can see this date. It's 15th December. Okay, I've come down yesterday. 15th December, 12 o'clock. 12 in the afternoon. The time is mentioned, and this is the candle which I am looking at. Now, tell me the closing price of this oil price when this candle stopped. What was the closing price? What was the closing price on 15 December at 12 p.m.? Because this candle closed at 4 p.m. actually, 12 to 4, because this started at 4. Yeah. Now tell me what was the oil price at 4 p.m.? Keep writing in your chat and look at the platform also. I will see the chat option after a minute, because if I move on to the different screen, this cursor will go. So tell me what was the closing price? This is the candle right here, 15th December. This closed at 4 o'clock. 4 p.m. What was the price of oil? How can you determine? Okay, let me just have a look at the chat. Okay, brilliant. Everybody's able to get it. 46.80, 46.90. How do you get to know? You get to know because you can clearly see on this cursor that the closing price is 46.92. And when it opened at 46.93 right here. Because this it closed here, right? And it opened here. Now remember this closing price which you have told me for 15 December at 46.92. Now I'll go 4 hours before, between 8 a.m. to 12 p.m. 15 December. Tell me what is the closing price. And remember what you have sent me, and now tell me what was the closing price of 15th December at 12 p.m. Because this candle is 4 hours, it started at 8 o'clock, but by the end, 12 o'clock, how much was the closing price? Guys, we'll give more 30 seconds to this. Now you know the drill, so you can easily find out what was the closing price before I switch on the cursor and go back to the chat option. So I want to show you why and what is the difference between 15 December 8 to 12 and then 15 December 12 to 4. So now I'm just going to go back. Okay, brilliant. So everybody can see difference was 46.56. So 46.56 means the closing price. You have answered, someone has answered 46.56. That is the right answer, because look at the closing price right here. It's not 46.79. Somebody said 46.79. That's the opening price. Okay. Closing price is C, last corner, top corner left, but C. That's the closing price. So 46.56. Now 46.56, 15 December, closing at 12 o'clock, right? And at 4 p.m., the other candle closed at 46.92. So now you understand why the other candle is green and the previous candle is red, because the closing price of 46.90, which was between 12 to 4 p.m. So at 4 p.m., when the candle stopped, the closing price was 46.90. Before that, the previous candle, which was closed at 12 p.m., the closing price was 46.5. So there was a difference of 30 cents, and that's why the later candle was green. Now, subsequently, if you look at 15 December, 4 to 8, 50, 15 December, 4 to 8. What is the closing price? And please keep noting this down, because you have said 46.92. You have also said 46.56, right? Now, next candle, 4 o'clock to 8 o'clock, 15 December. What is the closing price which you see right now? Same drill. And this will give you the answer that why there are red and greens in the candle. Look at the closing price of each candle. Okay, now I'm going to move my cursor and go back to the chat. I think you have figured it out. 47.65. Second, let me check. Absolutely, 47.65, right? Now everybody understands. So now when you see 47.65, you know that this is a higher closing than the previous one. So that's why that candle is green, right? So it's all about the closing price. That's how the red and green is determined. Okay, well, there is one question. Where do you see the time? I see the time here. Look at your chart. So when you select your cursor on the bottom right corner, you can select your cursor. On the bottom right corner, you can select a cursor, second last option, chart cursor. The moment you select the chart cursor and put on any candlestick, it will show you the time, and you can select the interval from here, 4 hours, like I have selected 4 hours. Next to it, there's a time frame, 6 days. So this is last few days. This is last 5-6 days. I increase it, I can increase it. I want to see last 1 month. I can see last 1 month of movement also. Every 1 hour, how it has moved in last 1 month. So the red and greens, everybody understood why there's a red and green candle now. Anybody who has not understood why there's a red and green candle? Is it clear? Give me a yes or a okay. Those who did not understand, tell me a no, and I'll try to reach out personally and I'll explain it to you. Or we'll see if we get more time, we'll touch base this again. But now do you understand why there's a red and green? Because the closing of the previous candle, if the closing of the current candle is higher than the closing of the previous candle, then this candle becomes green. If the closing of the next candle is even further higher, then that candle becomes green. But after that, if any candle has a lower closing than the previous, then that candle will be red, right? So please tell me if you have understood this. Give me a thumbs up or give me a yes, give me a okay, so I can move on and look at multiple time frames, how we look at different time frames, and we can start with a few technicals. Okay, I'm getting a few yeses. Okay, okay. All right, okay. Okay, so I see most of you have already got the idea of how this works. Okay, great. One or two people still not. Don't worry about it. before I leave, I'll do a touch base with it, or let's have a one-on-one session and I'll explain it to you why the red and green happens. So, okay, now let's try to understand the idea of time frames. When you're looking at this chart, let's look at one by one the components of a chart. First thing on the left is called interval. Okay, interval is what? Now, when you say interval is 1 hour, right now it says interval 1 hour, which means these candlesticks which you see, this is for every 1 hour. You click on it, it shows you the time 7 o'clock, which means 8 o'clock, 7 to 8, 1 hour, this candle will run. Okay, and if the closing of this candle is higher than this previous candle, then this candle will become green, otherwise it will close. Right now the closing of this candle is 47.36, the current price, and the previous candle closed at 47.49, so that's why this candle is red right now. If this particular candle goes ends after 1 hour above 47.49, then this candle will be here in green. So we will see by the end of this session, end of this 15 minutes, 14 minutes, that how this candle closes. So this is every 1 hour time period. Okay, this is 8 to 9, sorry, 7, this is 7 to 8, this is 6 to 7, 5 to 6, 4 to 5, 3 to 4, 2 to 3, right? So this is every 1 hour how it moves. So interval means you can get to see different intervals at how the oil prices have moved at different intervals. So this is every 1 hour. So you can see every 1 hour. If I select this interval from 1 hour to 4 hours, now you can see that this entire candle represent 4 hours from 4 o'clock to 7. So this was 12 to 4, right? This 4 to 8. So this is another 4 hours. This candle started at 4 o'clock. This will end at 8 o'clock also. So this is 4 hours right here. So this is what interval means, right? Now, when we look at intervals, you can also see like 4 hours, you can see day. So when I say daily chart, whenever I say daily interval, that means each one of this candle represents the movement throughout the day. So if you see this candle, for example, let's understand the anatomy once again. Look at this candle right here. This has an upper thread right here, which means the highest of the day on 10th December was 47.5. The lowest of the day was 45.5. To look at these threads, I'm just looking at this thread right here. So each of this candle represents now a day because I have selected the interval daily, right? Next, after the interval on the right side of this, you see history. It says 22 days. So you can change it up to you. If you select, let's say, last 1 week. So now already the interval got adjusted to your view, and now you can see last 1 week of the oil price movement. Okay. So why you see last 1 week? So it is clearly easy to identify. See, there's a big fall here from 47.4 to 45.76, right? On 14th December, right here. So you'll be able to see where are the significant falls and how it has again moved higher and has reached to this point. So these are your historical prices. From 7 days, you can see last 1 month how the oil prices have moved in last 1 month. So if you go slightly zoom out, you will see from 2nd November to 14 December how the oil prices have moved. So this is your historical. So the time frame or the entire period of this chart, you can adjust by clicking on the history. And if you want a much more regular time period, the interval, you can select, let's say 30 minutes. So now you can see the price pattern of crude oil every 30 minutes, how it moves every 30 minutes. Okay, now question, what is the best to monitor? Daily, hourly, early 5 minutes? This is a question a lot of people ask. That what should be the right time interval we should trade? The answer to this question, uh, many people will differ from this opinion, but let me tell you this, what I've learned. Time frame does not really control the volatility. Okay. Right now, you saw 5 minutes oil prices just went up quickly. Uh, if you're looking at a 4 hours candle, also, if there is a price volatility, it will reflect the same in 4 hours, in 1 hours, in 5 minutes, in 10 minutes. How traders use it, it has more to do with how many trades you have to execute. If you are a trader who would like to execute uh, trades like 3 or 4 trades in 30 minutes or 40 minutes, so you'll be looking at a much more lesser time frame. You'll be looking at every 15 minutes movement because you have to trade every 15 minutes, every 20 minutes. Somebody who is a swing trader, somebody who can, so swing trading positions might last a few days, a few weeks, sometimes a few months, because the entry and exits are very clearly defined. So you will not be looking at a 15 minutes or 20 minutes chart. So it's not as much as which is the best interval. It is more like how much trades you want to do. A day trader will have to focus more on the portfolio. If somebody's trading 20 times or 30 times in a day, putting 30 trades over a day, then you have to look at a much closer time frame. You will have to look at a 1 hour chart, 30 minutes chart, 15 minutes chart, because they're going to do 30, 40 trades in a day. So it will be pointless if you are monitoring a 4 hours chart, because the frequency of your trades is higher. Similarly, someone who has to put 2 trades in a day might look at 4 hours, might look at a daily chart and see how it works out. So, really, I mean, the interval is irrelevant to the efficiency of your trades. It has more to do with the number of your trades, the frequency at which you trade. So, first, you have to decide for yourself that what kind of a trader am I? Am I a day trader? Am I a speculator? A scalper? Scalper means who trades every 2 minutes. They look at a 2 minutes chart and they have higher volumes. So for example, 500 ounce of gold bought right away. It went up by $1, they booked profit $500. It went down by 50 cents, they booked the loss $250 out. Right? So scalpers are very fast, very quick, but their average quantity is very high. Obviously, they know them. They understand the idea of risk. Uh, Now, if you want to look at the multiple time frames to your advantage, you have to understand the idea. Again, as I said, find out what kind of a how much you want to trade. Now, let's say I'll take an example right now. It will be much more clear. Let's say if I have to take a trade right now. Right now, I'm looking at oil 30 minutes chart. Okay. I already have positions open. So let me close. Okay, I don't have any positions. I don't have any oil positions open, right? So let me look at the oil chart right now. So I'm going to do a live trade just to understand this. I'm looking at a 30 minutes chart. Okay, I'm zooming out to get a better picture of this chart. What I see is now this is where multiple technicals you can, at least first technical, what you can put something called a support and a resistance line. Okay, so we'll discuss time frames as well, and we'll see how support and resistance is linked with the time frames also, and how do we execute the trade on the basis of technical. And this is a very basic thing, guys. It's, you can always read more and more about support and resistance, but this is something very basic. How do you identify a support and resistance? I'm looking at a 30 minutes chart right now. Now, if I were to draw a line, so you go to draw tools from your options, take SR line or support resistance line, second option, select it. Now, look for very obvious points from where you see that the price touches and bounces back. So I'm going to go and look for very obvious points which are visible. You don't have to really find it. And the most important ones I can find first here, right? Then another. So these were the very obvious points I could see. Another support line I can find is also here. Not a very strong support, but still a support, right? And after this, if it breaks, then if I have to look for a support line, it's difficult to find it. it could be somewhere around this price. Let me draw a line for you right here. So let me point it out also why I'm drawing it here. So support line is a line which tells you those areas, those triggering areas where when price reaches, quickly bounces back. Okay, look at this. It came here and I'm looking at 30 minutes chart, right? Bounced back. Look at here, touched here, bounced back. Again, very close here, bounced back. Look here, touched, bounced back. Look at very candle specific, yeah, 30 minutes. I'm looking at 30 minutes. So there are multiple candles. So just see why I'm choosing this as a support line, just for your information, because most of the time it has touched, it has bounced back here, right? So this is one. And you see that once it breaks the support line, it goes for a while. It is not able to reach back. Look at this. When it breaks the support line, see what happens here. See, right now, the moment this support line was broken, look at this. Right here, the moment the support line was broken, it came down here. So support line acts as as the name suggests, literal support, and once it gets broken, the prices fall. Similarly, this is one support line. I took some multiple support levels. I saw this, right? And then I saw this right here, and then I saw this right here, then I saw this right here, again right here, right? And then there is a support line which is here. These, by the way, are not, this particular line which I have drawn is not, does not show very strong support. So basically this support has been broken for the 30 minutes. So I would not want to go for a buy. I would see another 30 minutes how it looks like. If it reaches to this point again, I'll go for a buy at 47.40. And where do I book my profits? I book my profits at resistance. What is the resistance line? Just like a support line, which shows you the price when it comes down, where it bounces back from. A resistance line is going to show you the upward ceiling, where the price reaches but is not able to break it. And once it breaks it, it just goes off, right? So this kind of determines your entry and exit areas. And right now I'm doing it on a very shorter time frame of 30 minutes. You can do this on a time frame of 4 hours. You can do this on a time frame of 1 day, depending on what is the frequency of your trades. Look at this, how strong this resistance is in the 30-minute chart. Just almost here, right? So if you find 3 to 4 stronger points, that becomes, so idea guys here is to identify a range. Right now, this is a 30 minutes time frame I'm looking at, but you have to find out the support and resistance level of your own time frame, what you're looking at, and it should be very obvious. You should not have to look for support levels. If you have to look for support levels, then it's not the right support area. Okay, now see, this candle changed in 30 minutes. Now this is a new candle which has started forming in the 30 minutes. You saw the shift in the chart. So this is about the oil prices. And technicals, in commodities and currencies, technicals will help you out because they're more volatile. In stocks, I would always suggest that first thing you look at is the fundamentals, and then to, once you have determined the trend, whether it's a buy or a sell, then you can look for technicals to determine entry exit areas. Support and resistance helps you identify when should I enter, where, at what point I should enter, what price I should exit. Now look at this 30 minutes candle. I did not buy at that level because I told you it doesn't look like a very good support, right? There are only two buys there, so it's not a very strong support. Because the previous support line was broken, the previous support line where there were 4 to 5 buys right here. Let me show you here. This was a very good support line right here for 30 minutes, got broken. So now another candle is again here on the red formation. I will not buy this right now. I should probably short sell this or just wait till it comes down to another buying level, which is 46.90. So I should be able to enter now. I should buy it here and should keep my stop loss depending on my risk. Day trading without stop loss is not a good idea. Never enter into a day trade and don't put a stop loss. Always put a stop loss. That's the basic common idea of trading. Okay, what technicals help you with currencies and commodities other than the support and resistance? So, see guys, one thing which you have to understand, support and resistance is your good entry and exit. It's basic, it's easy to understand. More support and resistances you frame, and if you do all your trading on the basis of you do your entry exits on the basis of support and resistance, it's good. There are few technicals which can assist you, but again, as I said, all these are technical perspective. There are a lot of assumptions on it. So sometimes it might work. If it doesn't, then your stop loss just got hit, right? How to put a stop loss? It's easy to put a stop loss. If you want to, let's say, for example, I'm here. Let's say I'm losing $155 in McDonald's right now. All I have to select is this pen and select stop loss right here and give an amount. Let's say I don't want to lose more than $500, so I write $500. At the same time, I want to book a profit if it reaches to 1,000, and then I modify. So both the levels are right here. If I'm in a profit of $1,000, this trade will get executed first. If my loss comes first, then my loss will be executed first. Now, other technicals which you can look at. So we understood how the support and resistance work. Let me also show you a few more technicals. So something which you can work with could be RSI patterns. Let me switch my presentation right here. Okay, so we understood how a candlestick works. Now these are some technical indicators. We saw support and resistance. There can be moving averages, there can be RSIs, there can be trend lines which you can use, or average true range. Now, support and resistance first, just to show you a graphical representation of what I did there. Understand how the support line works, and you see that how a strong support, if you see the very first line of resistance, that's where most of the time the upper ceiling, the price touches and comes down. So it becomes a resistance. So you know where to book your profit, right? And then you see the second line, which is acting a good resistance when the prices were down. But once that resistance got broken, it became a good support. So the support, when broken, becomes a resistance, and a resistance, once it is broken, if it is a very good resistance and it is very difficult to break, then it can become a very good support level also, right? I'll show you a live demonstration here on the chart of some good support and resistance levels. Let's see, for example, gold prices right here. I think everybody asks about how gold moves. So let's say right now I'm looking at a daily chart for gold. Okay, I'm going to take you way long back. I mean, you can actually see a lot. Let's say a weekly, which means a weekly interval. That means I'm talking about last 10, 11 years of gold. Look at this. If to talk about a very long-term strong resistance, was this right here, and a very good support. Look at this, because once it got broken, it went down, right? But look at these support, and look what happened when this resistance got broken. Since 2013, gold always used to come near 1350 and goes down. 1350 goes down. 13. It happened multiple times. Look at this. This will give you a complete idea of how support resistance works. Look, in 2013, it touched, went down. In 2014, touched, went down. 2014 again in July, touched and went down. Then 2016, again in 2016, then again by the end of 2016, then 2017, again 2018, 2018 March, and then it reached almost close February 2019. And then look, when this resistance broke, where did gold go? From 1352 all the way to 2000, right? Similarly, if you see the support levels, every time it touched these levels, bounced back. See, bounced back, bounced back, bounced back. But then it broke the support, it went down, and then when it recovered, again continued for a good support level here. See, very close. See, 2018, right? So these are support and resistance level, which from a very, and this is a very long-term chart, guys. This is, I'm talking about last 10 years of gold. You can short this down. You can look at last 1 year. You can look at last 6 months. You can look at last 30 minutes also if you want to. So that will help you understand that uh, the most important part about any commodity is to first find out the support and resistance, because that's uh, what is going to tell you the entry and exit. Okay, question: is it a rule of thumb that the stop loss should be smaller than your take profit? Uh, it does helps a day trader to apply that rule. If you have a notebook, uh, I want you to write down something. Let's say you take 4 trades in a day. One trade you will put in a currency, well, one trade you put in a commodity, one trade you put in an index, one trade you put in agro commodity, anything. You took 4 trades in a day. Okay. There are 20 trading days. So let's say if you're taking 4 trades in a day, every trade you have, so write it down on your notebook. You took 4 trades in a day. Every trade has a take profit of $2 and a stop loss of $1, which means if your loss is $1, your stop loss get hit, but your take profit only gets hit if it is $2, right? You took 4 trades on that day. There are 20 trading days in a month, odd, which means 20 into 4, you took 80 trades in 1 month. Now let's take a scenario where 60% of the trades which you took went wrong. 60%. 60% of 80, which means 48 trades went wrong out of 80. It hit your stop loss. Your stop loss was $1, right? So 48 into 1 is equal to 48. Remaining 32 trades went right. So that was the remaining 40%. 32 trades went right, which means it hit your take profit. Your take profit was $2. So 32 into 2, that means 64, which means even after 60% of your trades went wrong, you still ended up in a net profit because your risk to reward ratio is 2:1. So it's not a rule of thumb that the stop loss should be smaller than your take profit. It just kinds of defines a good trading strategy if it is. Okay. Many people do 1:1. Many people do 2:1. But please don't go to a point where you are holding your losses around $4,000, $5,000, and the moment you see a $300 profit, you booked it. That's not the right way to trade. That's a very bad risk reward ratio. My father, he did not do his bachelor's, uh, just finished his class 12th, got in college, but was not able to finish the first year. He had to find work. But the other day when I was reading about risk and reward ratio in a book, and he asked me what I was reading, and I said, see, this is risk reward ratio. He said, yeah, but why you have to read a book about it? It's a common sense. You risk this much to make a profit of this much. You see, that's a common sense. You are not going to risk this much if your profit potential is this much. So just follow that. I mean, try to do a couple of trades in your demo account, and I think you should track it and see how it works out for you. Can you tell us about Fibonacci? It's so complicated. I'm not telling you about Fibonacci because it is complicated. It's not really that complicated. It's really interesting though, and you should use Fibonacci's in your daily trades. Right now, I just wanted to give you a very basic introduction of charts, candlesticks, time frames, and support resistance. I'll probably give you a one or two more technicals, but for Fibonacci, I would suggest anybody who wants to learn Fibonacci, uh, please come on a one-on-one session, and I'll be able to explain you Fibonacci's really well. It's not difficult at all. It's really an amazing tool to trade with. It comes within an advanced technical analysis, so that's why I didn't want to bring everything together. First, you understand how charts work, you understand how time frame work, how candlesticks work, how support and resistance work, and then slowly we'll move on to the advanced bit also. Can you please explain trailing profit and trailing stop loss? So trailing stop loss basically is the concept, trailing profit not that much, but trailing stop loss is the concept. I'll quickly show you how trailing stop loss work. It's a good strategy. It's definitely a good strategy. We'll also look at the moving averages also. Somebody pointed out moving average. We'll look at moving average also. Let's understand the trailing stop loss strategy. And we can do the trailing stop loss today because look at this. I have a $15,000 profit in gold. Okay. Now I bought gold when 1828. Right now the price of gold is how much? 1856. I do not have a stop loss and take profit. You have seen this demo account last 3 days. I have not closed my gold position. It was in a loss. Then it became in profit. Yesterday I met you. It was in profit. Today it is in profit. I have not put a stop loss or take profit. Tomorrow if I come and gold prices go below 1828, I might be in a loss also, right? It will be really unwise from my end to let this profit go. But if I book this profit right now and gold goes back, let's say to its previous high, 1866, which is today, then I will be losing on maximizing my profit, right? So trailing stop loss comes with the idea of maximizing your profit at the same time keeping some of the gains which you already have. So how do you do it? Let's say I'm going to put a trailing stop loss right now. How do you put a trailing stop loss? Same way you put a stop loss, but this time you switch this regular stop loss to trailing stop loss order. Select trailing stop loss, and now what you do is put an amount. I have a $15,000 profit. I want to at least have, I want to keep a cap for $10,000, which means I bought gold at 1828. Okay. I kept a stop loss at, I'm going to keep a stop loss at 1838, which means anyways, I'm making $10,000 above the cost. Okay. And I'm going to modify this. So now what happens? Look at the price, 1838.81. That's my stop loss. But if price moves higher, then my stop loss will also continue to go move higher, which means if price comes down from 1857 to 1838, my trade will get hit, my stop loss will get hit. But all I have lost right now is just $5,000. The remaining 10,000 out of 15 is in my bag. If the price hits, it goes to 1838. But what if it goes to 1868 right now? Look at the current price, it is 1857, right? If gold price goes to 1868, then this trailing stop loss of mine from 1838 will go to 1848, which means it is moving, it is trailing the price right now. So that's why they call it a trailing stop loss. With this stop loss, it trails the price automatically. You don't have to manually keep moving your stop loss higher or keep a cap over it. Once you have put, see, I put it at 1838, right now it is 1839 because the gold price went up. If the price moves by another $1, my stop loss will become 1840, right? You should exercise trailing stop loss only when you are in a substantial profit and you want to maximize your profit further. You want to see where the market goes. If you see right now, with every cents increase, my stop loss prices are also increasing, right? But if price goes down, then trailing stop loss will not go down. Okay, it will continue to, if price goes up, trailing stop loss goes up. But if price comes down, so look at this diagram right here. What I'm telling you right now. This is your trailing stop loss. This is the price. Price goes up, trailing stop loss goes up. It goes up further. This goes up further. But if it comes down, it hits this. So earlier you would have booked your profit here, but now you have booked your profit here. So that's all what trailing stop loss is. Kind of gives you that profit maximization feeling, and you don't really have to worry about whether you have maximized your profit or not. Okay, now we are going to have a quick look at a few more technicals like moving average. For example, how a moving average works is, so we're going to take example of, let's say, a stock this time, Tesla. Let's take example of Tesla or Amazon, for example. Let's take example of Amazon. Looking at Amazon chart right now. Okay, let me remove all the drawings. Okay, and this is the Amazon stock price chart. As you can see today, Amazon price is up by 1.5%, and that's why there's a profit in our portfolio because we bought Amazon. Now, if I have to see a moving average, first of all, what a moving average is? Moving average is the averages of, so you can say that what is the average closing price of this stock? And this average is calculated for 20 days, 30 days, 50 days, 100 days. So this is basically, if I'm calculating, look at this technical right here. Next to draw tools is technicals and something which is called SMA or simple moving average. And then there is exponential moving average. So let me show you simple moving average. Click on simple moving average. There's this line which comes in, and you can even do a setting here. This says length 50. Length 50 means it's a 50 moving day average, which means in last 50 days, what has been the average closing price of Amazon? Now, this pink line here, this shows the average closing price, 31.78. Let me increase the size of the text. This 31.87. This is the average price. Now they say what it is said that if the stock price closes below the simple moving average, then the trend is on the downside. If it closes above the simple moving average, then the trend is on the higher side. Now this is a simple moving average, right? If you see, this is 50 days. If I have to change the duration and say last 200 days, what is the average closing price in last 200 days? Now the situation changes because now you're looking at a long term or 200 days. So until Amazon gives a closing below $2,800, it is expected to be on the higher side. Okay, but the moment it gives the closing below 2,800, consider a change in trend and stock might start going down. So that's the importance of the moving averages. uh, are gold and USD dollar inversely or directly related? Gold and USD are inversely related for the fact that mostly gold is valued against dollar. Uh, However, sometimes this relationship is completely out of this correlation. Like, for example, during the trade war, dollar was going stronger, it was going higher, and due to the uncertainty of what is going to happen in the world, gold prices were also going higher. Okay, so that is something which, that's the time when gold and dollar might ditch that relationship. But otherwise, there is a inverse relationship. When dollar gets stronger, we see gold prices getting weaker, and vice versa. If dollar is getting weaker, we see gold prices getting stronger. Can you tell us more about such obvious relationships? So, uh, all the commodity-based currencies, like if you see crude oil and Canadian dollar have a positive relationship. If you see crude oil prices going stronger, then Canadian dollar becomes stronger. Not USD CAD. USD CAD means dollar versus Canadian dollar. I'm talking about just the Canadian dollar. So Canadian dollar and oil prices have a positive relationship. Most of the time, you will see they both move in the same direction. Uh, Another correlation you can see between gold and Australian dollar also, and it's a positive correlation. So how USD has a negative correlation with gold, Australian dollar has a positive correlation with gold. For a very long time, their charts matched completely on a positive direction until the trade war happened and it completely differentiated. So you can take trades, like if you're buy on dollar, you can buy gold also, because you know that if one gets stronger, the other gets weaker. So you can kind of diversify into your portfolio and restrict your risk, right? So another guys, one more thing before I finish this, I really wanted you to look at the strategy also. There are few strategies which are combined with how we put historical price movement into work. There's a lot of backtesting of strategies. I'm going to share something with you, and then something really, really interesting. And you should take a picture of this if you wish to. I have to share this with you. I had this thing in my mind that I wanted to show you. This was okay. A few examples of how we can take advantage of. Okay, it's here, right here. Here it is. Are silver and gold positively related? Very, very good question. Gold and silver, both are precious metals. Um, they were positively correlated. They still are positively correlated because when gold prices go up, mostly the silver prices follow. However, we saw trade war as a big exception. And what trade war did, uh, because there was a slowdown in manufacturing. Silver is an industrial metal, so it started coming down because of the manufacturing slowdown. But because of the uncertainty of the trade war and the relationship between US and China, gold went up. So we saw an arbitrage opportunity where gold is up, silver is down, but we know that both move together. So we bought silver and we short sell gold. And there was a time when the gap reduced and profits were booked. But then when there was a lot more uncertainty when pandemic happened, we saw silver going down further and gold moving further. So a lot of people booked losses also in that strategy. So you need to be very careful between when you're trading in a gold silver ratio. We're going to discuss all that tomorrow, more and more strategies. Today, I wanted to show you something called seasonality analysis, guys. This strategy was made 4th of November 2019. As a, I think was a previous one, not 2019 actually. I think it was on 2020. I think the year is not right. Let me just check if it is. Yeah, sorry. This was done this time on 2020. I think the date is wrong because I can see the figures of 2019 right here. What does seasonality analysis do? So we backtest last 10 years of data of we take one commodity or one instrument and we test 10 years of their return month on month. And then we try to understand any kind of similar patterns if we can find. Now you look at this chart. This is an orange juice seasonality chart, which is, so what we actually did, we did a month on month return for last 10 years of orange juice, and we found out that barring everything, November is a month where most of the time we have seen positive returns in last 10 years, except only two times back into 2010 and 2019. Rest, if you see the average 10 years of return, it has mostly been positive. Reason being, orange trees do not grow well in regions with extended periods of cold weather. November is known to be a chilly season in US, impacting the supply. So the weather across America is blowing dry to cold, stressing crops and harvest and creating bull opportunities for investors. So we issued this flyer expecting that possibility. If you see the probability of this, out of 10 times, only two times it has shown negative returns, but most of the time it has shown good positive returns. So this was a seasonality trade on the basis of technicals. And if you see, check the platform out because that's the most important thing. If you look at the platform and if you see how the orange juice seasonality has go in last November, look. So I'm going to write orange juice here. Okay, look, this was for 4th November 2020. And look what happened in November, orange juice prices. 10th November, 11, 12, 13, 14. From 115, it has went up to 128. November, and then December came in, and then the prices fell down, right? So this is seasonality. Again, if I have to put now again next year in November, we will come up with this flyer and put this positive returns on it. So this is called seasonality pattern, guys. This is a mixture of fundamentals and technicals. When we see a technical pattern over last 8-10 years, we try to find out a fundamental reason behind it, that why it is happening. Especially in case of commodities, it is possible to find a fundamental reason. These trades are called strategy-based trades. So out of your daily speculation and long-term investments, you can try to understand these strategies. Are these 100% assured? No. As you saw that out of 10, there are 2 times when the returns were negative. But then these are the probabilities with which you have to go if you're using a strategy-based or an analysis-based trade, right? So sometimes there are consultants who are doing this analysis and trying to make things better. Now, before we leave, let's take one more technical, something called RSI. And RSI helps you understand that at what price the commodity is undervalued or overvalued. So you select RSI from this pattern. Okay. Now let me change the interval. It's too high. Let's make it 4 hours, for example. Now RSI has a very simple funda. Look at this. I've magnified, I've zoomed in. Price above this blue line, which is 70%, it means that this particular commodity in this time frame is overbought and it's time to sell. The price, when it comes below this orange line, which means below 30%, it shows that the commodity is highly oversold and it's time to buy. So it can actually give you a lot of entry and exit points in different commodities and currencies. Try to use RSI in your patterns and it might work out for you. Just try to do some trades on the basis of RSIs and you'll be able to see it. Okay, I'm studying as of now in university and want to get into this industry for my career. I saw that you have completed CSI. Any chance you can give me more details on what to do in order to? Definitely. Let's connect over a call and I'll explain you how we can give exams and do that. Few months ago, oil went minus 35. It did, yes. What does that mean? What it means, you have to take delivery. So good part was, you know why it went to minus 35? Because that was the day of the expiry of the oil contract. So how, see, it's very less time for me to explain you future, but let me tell you, somebody asked about what does live cattle means. So every agro commodity or every commodity in the market is traded as a future on exchange, future contract. It's a very easy concept to understand, but then I have to make it much more detailed for you. Just understand this way. Oil went minus 35 because traders on the exchange, if they continue to hold oil contracts or future contracts, then on the expiry, they would have to take deliveries. Delivery means physical barrels of oil. None of that you have to do when you're trading online. But if you're trading with exchange and you are buying physical contract, and normally the oil traders which are who would like to take physical deliveries of oil, they take contracts on exchange and they sometimes speculate also. But if they don't have any place to store oil, what happened? This minus 35, it went in April. What was happening in April? There was a pandemic in April. There was a lockdown in April. No demand for oil. Also, what was going in April? The oil price war between Saudi and Russia. So oil was produced at its maximum capacity. Now, any oil trader who was holding a future contract knows that if this expires, I have to take physical delivery of oil. But because of so much of excess of production between Saudi and Russia, all the storage houses were full, plus the lockdown completely slowed down the manufacturing, so no oil was used there. So there was a shortage of the storage. Under that time, if you take the delivery of oil, where are you going to store? And the remaining places which have the storage capacity are charging too high. And this is not going to be used for so many months because you don't know when the lockdown will be over. So everybody started closing their contracts and they started selling oil contracts, which actually pushed oil prices negative. Now, I know many of you thinking that negative means what? If I buy oil from anyone, I will be paid $35. So it is not the real situation. It was done on future contracts. Okay. So future, and that contract expired on the very same day, and a new contract came in. So you want to know about futures? We will sit and will try to understand about futures also. So that is also something which is very interesting, but it is not that complicated also, right? So before we move on, there is one more question: the difference between RSI and stochastics. So stochastics and RSI, uh, they are both price momentum oscillators. Okay, and both of them you can use them if you want to forecast the trend. Like RSI, if you want to forecast the trend, is it undervalued or overvalued? Stochastic is also, the objective is very similar, but their methods and their theories are different. If you see stochastic, it is kind of predicted on the assumption that closing price should close near the same direction as the current trend. What RSI is doing is it is tracking at what price it is too much overbought or oversold. Okay, as an analyst, most of the people will be using RSIs over the stochastics. Both are very well known, but most of the time you will see that the analyst will prefer RSIs only, because of the reason is that the stochastics are based on the idea that closing price should confirm the trend, and RSI, it kind of tells whether the particular commodity is overbought or oversold. So it's a different method. I think there is a significant difference which you will find it in there. What is MACD? MACD is moving average convergence divergence. So MACD, how it works is, if you're looking at the very chart, let me open the gold chart itself. Let me put MACD here. So you go to technicals, you go to studies, and you select MACD. Let me remove RSI. Okay, and let me zoom this. Okay. Now MACD is so MACD again. It kind of tells you when you're looking at MACD, you have to understand the idea of how a moving average it works. Like for example, uh, MACD is basically used to identify a new trend. Like if there is a possibility that the trend is shifting, okay, and that is the topmost priority. So there are two lines which you see, and there are three different periods which you see. A very clear idea, if you want to understand this statistically, again we can have a one-on-one session, but let me show you how you can use the MACD to identify a trend. uh, Let me zoom this in. Just see it this way: whenever there is a positive crossover and you see these three histograms, now this is a 4 hours chart, right? If you see three histograms on the higher side and there is a positive crossover, right, right here, that's where the trend changes. Okay, and whenever there is a negative crossover, like over here, if you see right here, three histograms, four histograms over the 4 hours chart, it kind of confirms a negative trend flowing in. Unless there is a crossover, don't take a trade, because it might reach very close like this and then. But whenever there's a crossover and you see three or four histograms confirmations, it will give you a idea that the trend is changing, right? If you see, go negative, look here, zoom out, you will see that there is a positive crossover right here. So it went on for a while, right? Then there was a negative crossover, but you need to wait for a proper 3 to 4 histograms formation like this. Many of the people, they do this mistake that the moment they see one negative, they just go and change their trend. That's probably not the right thing to do. You have to wait for a formation of proper 3 to 4 bars of closing, like here, where you can see the confirmation. So MACD can be used also. What are the must-have in terms of indicators? Fibonacci's can be really used well if you are a daily trader. For Fibonacci's, we'll do an advanced technical session and we'll inform you, or let's have a one-on-one session, only focusing on Fibonacci's. But then support resistance, you should definitely have support resistance. Support resistance gives you a very good understanding of the range of the instrument. So it can gives you very good entry and exit points. So support and resistance is really, really important. RSIs could be good to identify the overbought and oversold areas. So that is good. Each histogram is of what time duration? Just like what you select. 4 hours. I've selected 4 hours, so 4 hours. If you select 3 hours, 1 hour, date, it's up to you, right? And live cattle. Somebody asked me about live cattle. Live cattle is also traded in exchange. Live cattle is the actual cattle, like cows and sheep and buffaloes. So there's a future contract for that also. Obviously, there's no physical delivery on the online platform. There won't be cows and sheep standing next to your door if your contract expires, but it has a value and it trades. Live cattle, feeder cattle, and other agro commodities as well, right? So, guys, have your demo accounts ready tomorrow. Tomorrow, we will discuss uh, trading strategies. We will discuss seasonality. We will do some live trades on the basis of technicals, the support and resistance. We will understand some pair trades, and we'll also go through the market outlook. So tomorrow's session might be very, very useful for you because we are going to discuss a portfolio of stocks, what is good right now to invest into, what is the outlook for 2021, which are the good areas to invest. A combined session before we uh, end the session for Investor Education Week, right? Once again, everyone, I know the time is very less and you have a lot of questions. Let's have one-on-one sessions, talk to your relationship managers, and we'll have one-on-one session after this Investor Education Week is over. Um, I hope I see each one of you tomorrow as well. You have been such a great and responsive, wonderful crowd, and I really love to spend time. So please give me a chance for tomorrow. Come in this session, and we'll use all these things what we have learned in last 3 4 days. Try to do some trades, do some short selling, put stop losses, take 4 or 5 instruments, diversify, learn the market news, and look at different kinds of strategies and portfolios and the market outlook for 2021. Till then, please stay safe, wear your mask, stay in good health. I'll meet you tomorrow once again. My name is Yogesh. Please leave reviews on Google for Century Financial. This really helps us keep going throughout, and we are going to do more and more sessions like this. So please go ahead. There were pros and cons we have already discussed. Do review us on Google. This would be really a good help. And if you have any doubts, again, guys, please take demo accounts from your relationship managers. They will definitely help you out. So once again, my name is Yogesh. I'll see you tomorrow, same time, 7 p.m. Please be ready with your notepads. We have a lot of work to do tomorrow.